I'm your professor, you are my students, so we have to do it. We have to be really, really tough. So, concentrate on the part 5, which is by far the longest. So we had these techniques, and I reminded you about that. This table that we have already calculated some levels of net present value at certain rates, 0, 5, 10, 15, and 20. Now, we are going to demonstrate 3 methods that will make us closer to the internal rate of return. I mean, really technically speaking, this would be just the answer. We are just arriving to the answer, pretty close. So how it goes? Please concentrate on the level that at 10% net present value is 4.13, and at 15% rate net present value is minus 2.46. We have this in mind? Yes. So, now we will have a close look, again, step by step. So, if at 10% internal rate of return, this NPV would be plus 10.1, plus 413. Okay, at 10% NPV is 4.13. But if the rate is 15%, then the NPV becomes negative and it's minus 2.46. Now it's the crucial point. So when IRR changes by 5 percentage points, the change in NPV at the same time is, this sort of distance is 4.13 minus, in brackets, minus 2.46 equal 6.49. This is the distance when you just could imagine on a aisle like vertical 4.13, then through 0 minus 2.46. It's the distance between them. It's the delta of NPV. This is the change. So once again, when IRR changes by 5 percentage points, it means that the difference in NPV is 6.59. So the method, first method, the fastest, the quickest, is like 1% of change in IRR will lead us to what change in NPV in euros? It will lead us to 6.59 divided by 5 means €1.32. Okay, let's concentrate again. So it means that 1% change of IRR means 1.32 change in euros in NPV. So we could see that what kind of difference in IRR could cause 4.13 euro, because at 10% we have positive 4.13. So we just try to bring it to 0 to find what percentage point would bring us to 0. I mean, we try to convert now euros of NPV into percentages of IRR. And we have found that 1% change in IRR brings us to 1.32 euro change in NPV. Therefore, now we take this 4.13 euro and we divide it by 1.32 and multiply by percentage, because we try to find the percentage points. And by doing this calculation, we arrive at 3.13. Therefore, the internal rate of return in this case will be 13.13, means 10% that we took as a basis, and then we add up this 3.13%. Oof, I know, it was sort of mathematics, but it was not so complicated, I hope, at least. So now let's have a look on the sort of combination number 2 that it's recommended by the concept of this course, and it looks like this. Again, sort of tedious combination, but as well it would end up with some numbers, because we already found that 1% of change in discount rate would lead us to 1.32 change in NPV. So we might go like step by step, like deducting. So at 10% we have this 4.13 euro. So to arrive to 11% internal rate of return, we just subtract this 1.32 that corresponded to this 1 percentage point. So when IRR is 11%, we subtract 4.13 minus 132, and we arrive still to the positive NPV of 2.81. Okay, so still we have to do another step, because IRR, now we do it at 12%. So when we arrived at 11% to 2.81, now we take it as a basis and we subtract 1.32. What leads us to the new net present value at 12%, which is 1.49. It is still positive. So again, we do the next step, which is IRR at 13%, which we take the basis from the previous one, 1.49, minus corresponding for 1 percentage point, 1.32, gives us now the NPV at 0.17. So we came to the conclusion that at 13% of internal rate of return, we still have a positive 0.17 euro NPV. In next step, we will have some rounding up, but then we are now trying to split this 0.17 into smaller fractions. Because if we know that 1 percentage point corresponds to 1.32 euro of change of NPV, so normally 0.1% of change in discount rate divided by 10 will bring us, divided by 10, to 1.32 change in NPV. As such, we are now trying 13.1%. So in this, we added 0.1 of percentage point. So from 0.17, we subtract this corresponding 0.132, which leads us again to 0.32 of positive NPV. Now, we could be even more ideal, more proper, because 0.01 percentage point of discount rate will lead us to 0.0132 change in NPV. So to jump a bit faster and sort of rounding up, it's like we multiply 0.0132 by 3, we'll arrive just almost to 0.038 euro. Therefore, it's like 3, so we add this to the internal rate of return, which is now 13.13. Wow, this was an effort. In the meantime, sorry, I have the sunset here, so I have to put some light. I'm very sorry. Okay, I'm back. Sorry, I'm back. Okay, it was tedious, quite complicated in the calculations. So you might ask, what? Really? There is nothing simpler than this? We have to deal with all that like bit by bit? Unfortunately, yes, this is trial and error method. But there is a formula. Yeah, the formula is not sort of wonderful, but yeah, there is. We need to calculate some things earlier, and then we arrive to the formula. The formula looks like this. So what do we have in this formula? Actually, we have to calculate, we have to investigate the one which is positive and one which is negative. So we have to find, firstly, two rates, discount rates, at which we have two NPVs, one positive and one negative. And then we calculate this NPV, net present value, and we have the ingredients to put into the formula. And the small r with index A is the lower discount rate chosen, and r with this index B is the higher discount rate chosen. So we put this formula into this set, and we have like IRR is equal, just to be sure that we speak all about this. We use these figures, yeah? We are sure. We use these figures. 10.15 and 4.13 minus 2.46. Okay, let's come down. So we take the lower discount rate, which is 10, plus, now we have this expression with NPV at lower rate, upper, divided by upper, this higher NPV minus this lower negative. So it gives us the proportion, and then it's multiplied by the difference in rates. Please check that you have exactly the same thing, because this is the formula that brings us as close as it is possible to this magic internal rate of return. The formula looks a bit complicated, but when you have some more time and you look closer, you will find that the formula replicates faster and more concisely the things that we have done in the first and second idea that we have just seen. Fine, but then you might say, really, I have to do it like that? Oh wow, it's so tedious. Is it not and in practice when I am at the job, any other idea? Yes, we have to say about that. Because as a matter of fact, we could use an Excel sheet. So this is the idea. We have this investment at 435.44. Then the cash flows are 100 in the first year, 200 in the second year, 300 in the third year. And our question is as simple as that. What is the IRR? And the second, if we require 18% return, should we decide for this investment or not? So let's make sort of impression from the Excel sheet. It looks like this. That is the formula. At least it should work. And then when we put this, we click this, then we find 15%. We calculate it. So what is our answer? Our answer is that the IRR is 15%. If we require 18% return, we should reject this investment. So for those who would like to test it, please do it. We may do it in this way as it is here. Somebody would volunteer perhaps to calculate. There will be no prize for that, only for those who are really wanting to do it. So, and again, if anybody would like to be very, very, I would say, in front, as well, you could test this with the calculations. So, I will sum up this lecture with comparing. Maybe I will start the next one with this. So, ladies and gentlemen, because we have to finish this part 5, you have just survived several methods of calculations of IRR. Please sort of digest it at home. Or maybe no, because, sorry, I just miscalculated minutes. So I will make the summary. So, sorry for that, because I just try to mastermind everything. So when we use the NPV method to evaluate a capital project, the discount rate is the rate of return required by investors for investment with similar risk, which is the project's opportunity cost of capital. This is a benchmark. Okay? Try to remember, we use the method of NPV by assuming a certain discount rate, which is satisfactory for some investors. So at this discount rate, the NPV will have to be at positive figures. right? This is the concept of this rate. And then the second thing, when we use the IRR, we are looking for the rate of return associated with the project itself, so that we can determine whether this rate is higher or lower than the project's opportunity cost of capital, which is the rate of return required by investors for investment with similar risk. So when we use the calculations of IRR, as a matter of fact, it means that we are finding this internal rate in this project, because we might put some money somewhere else when it's risk-free or better, whatever. So we have to compare. So when IRR is getting to be higher, then we are accepting this project, right? So we have to see these rates mathematically. They are like the same, but we are looking at them on different perspective. So again, a final word. Oops, I'm just too fast. So which one is better? It depends. Again, it depends. Because when we calculate NPV, this is in terms of money. How much money it will come from this project to the company. And when we calculate IRR, internal rate of return, then we have this sort of rentability. We shouldn't say it like this, but it's like rentability of the project. Both of them, of these procedures, they give us tools for decision rules. Which one is better? This is a great question, because it depends again what we measure. We measure the amount of money, or we measure how rentable the project is. So IRR gives us plenty of information about the project, but unfortunately with IRR, which might seem better, there are several pitfalls. I just tried to explain pitfall by putting these Chinese characters. And there are 4 main pitfalls. But they are pretty complicated. Therefore, we will talk about this at the next lecture.